Welcome to the May 14th, 2025 meeting of the Sinking Fund Commission. This meeting is being conducted virtually via Microsoft Teams and pursuant to Section 21-1503 of the Philadelphia Code. Electronic recordings of this meeting will be made available through the Teams conference technology and via an audio recording. That recording will be made available to the public through the Commission's website without any charge in the next 10 days. And please note that by attending, you consent to such recording of the meeting and your attendance at it. With that, I will turn it over to the chairman, Don Scott, to start the proceedings.
Thank you, Christopher. I'm pleased to call this meeting of the Sinking Fund Commission to order. The first order of business is the approval of the March 2025 Sinking Fund Commission transcript. Is there a motion?
I'll make a motion to approve.
Second? Motion has been made. Is there a second? Okay. Motion has been made and properly seconded. All those in favor, just say aye.
Aye.
Ayes have it. Chris, before we get into the agenda, do you have any comments you'd like to make?
Before turning it over to Kwaku and Lee, I just wanted to note, and they'll go through the performance numbers, what happened in April, what's been happening in March, what's been happening so far in May, as well as touch on a possible slight modification to investment guidelines for Copeland. But I just wanted to note, as of this morning, there's a little north of $675 million in assets in the sinking fund, and that includes about $7.5 million in the cash account. With that, I will turn it over to Kwaku and Lee.
Great. Good morning, everyone.
Good morning.
And it's definitely been a very quiet, busy, normal market environment since we last got together. So not much to really report on. And that would be Marquette's report. So with that aside, I think today we're going to go through some pretty good talking points regarding what's going on with the economy. Lee will touch upon performance in the portfolio, specifically how some of the managers, the quality tilt in those strategies has been helpful. The discussion around Copeland, that's also got the lens of quality and downside protection in mind. So as we're conscious and we think about the asset allocation, we'll continue to kind of hit upon where we can continue to help protect on the downside with the portfolio. But with that, I'll jump into the market environment. And Lee, any comments from your end before I kick in and start going through the market environment? Just wanted to make sure I didn't miss anything we synced up on.
No. Fire ahead, and I'll pull some of your thoughts into the relative performance discussion.
Okay, perfect. So with that, we have the executive summary. And as of March 2025, so the good news is the market has definitely buoyed up and down since March 2025. And in a moment, we'll talk about the reasons for the sell-off. The sell-off can be directly attributed to the White House, the tariff policy, and the market's response to that. Now, some interesting things have taken place as we start looking at how the market has reacted. I'm going to make this a little bit bigger just because I'm squinting, so I'm sure you'll all be squinting as well. But if we look across the returns, this is something that we haven't seen in a while. So your non-US equities are performing really, really well, and your US equities are underperforming. And typically in environments where we see stress from a global standpoint, even if there's a trade war and the US has been the instigator of a trade war or has been the aggressor, we've typically seen the dollar strengthening and the US market still hold up better. In this environment, the non-US market, again, has been the beneficiary of this trade war. One of the outcomes of this trade war has been a depreciation of the dollar. So we'll talk about that momentarily. And the trade war has also put the economy perhaps in a more delicate position than any of us would have thought. So going into 2025, the debate was, Are we going into a soft landing? And have we missed a recession? Those were basically the bookends of the discussion. Right now, as the year continues to mature, the conversation is how deep will the recession be? And are we looking at stagflation as a potential scenario? So that really just points to the shift that we've seen in the environment. And again, the tariff policy is a direct result of that. Now, as we think about the market's reaction, once again, we'll see that on the domestic side, year to date, those figures are now negative, meaning that January was a strong month, February was decent for some segments of the equity market, and then March really just led to that beginning of that sell-off, which we saw a bottom of that around the first week of April. One interesting point here is the value component of the index. So value being up 2.1% through the end of March and growth being down 10%. So that does point to your quality types of stocks finally being recognized and loved and rewarded a little bit more by the market. And your growth names, the so-called Magnificent Seven, being underweight those would have been a significant tailwind in the portfolio during this period. And again, as we think about the international markets, and we have a few slides that will touch upon this, the international markets are comfortably outpacing the domestic market. So definitely more of an anomaly where we're used to seeing the US market do well. And it's usually a conversation around, well, when will the non-US equity market catch up? Just to kind of sprinkle a few points around this and touch upon the trade war. One other thing that's also been a direct contributor to the boost that we've seen in returns in the non-US market is the real-time revision of basically the Marshall Plan, the Bretton Woods, post-World War II pacts that were really put in place, where the US led the global world order and other countries kind of fell in line, right? That was really the type of system that we've been used to since 1939 onwards. But with the discussion that happened in February with Zelensky, Ukraine, the future of NATO, you're also looking at European nations now investing heavily in their own defense sectors. So that expenditure has also been somewhat of a tailwind for the non-US equity market. So defensive stocks, manufacturing stocks tied with defensive production, that's also been part of the pull or the return on the EFI side of things. And then currency, definitely a big dominant factor. And then also commodities also helping emerging markets. So with the trade war, I won't go through every single point because the real takeaway here is that there's a lot of points, and on any given day, one point can get put forward, another point can get retracted. If we think about how the market behaves, and the market is a collection of individuals and organizations, a lot of psychology when you think about the markets and how things move. When we think about psychology and something's on the table, is taken off the table, is put back on the table, we look at all these points between January, February, and then we have another page where we get through to April. This just gives you a sense of how nauseating the tariff discussion has been for the markets. On any given day, 25% tariff is slapped. That's then re-upped to a higher number, then it's taken back. Tariffs are put on electronics, suddenly they're kind of reversed. These types of movements have a very destabilizing effect on the markets, for lack of a better term. When we think about tariffs, the T in tariffs, this is something I learned in Econ 101, that stands for tax. So tariffs are a taxation. So as you think about the US consumer, if there's less money in your pocket, less discretionary spending, that's also going to have a multiplier effect on the economy. So all of these bullet points here, while the intent has been to strengthen the US's negotiating position, the outcome has also been negative when you think about the day-to-day cost of living, the supply chain disruption that's expected, and then ultimately the pain that the US consumer is projected to feel during the latter part of the second quarter going into the third quarter of this year. And then as we think about the tariffs and where they've been slapped on, these various goods here, we've seen the, Lee, should I say aluminum or aluminum? But anyway, this type of metal that's here, it's been slapped on here where you see the aluminum, you see the steel, automobiles, pharmaceuticals, semiconductors, copper. And why are these things important? Well, these are essential inputs into production. So to make a phone, to reshore jobs, to buy any good that we rely on in our day to day, whether it's in the grocery market, whether it's the phone in our hand, some of these inputs are critical to that. So the fact that we're looking at tariffs on those just again has that effect of raising prices. In addition to raising prices, as and when those tariffs go up and down, it also has the effect of adding more uncertainty to a company's projections. We're seeing company projections, earnings projections get written down to a pretty healthy degree. So again, a very destabilizing effect when we think about the economy. And overall, when we think about the trade policy in context, and here's an example, a trade deal was put in place with the UK. We, the US, have a trade surplus with the UK. So the fact that we have tariffs with a trading partner that we have a surplus with also points to the fact that the market is going to take some time to really absorb what this all means. And the longer the market really guesses in terms of what things mean or what's happening, the more volatility we can expect. So that's the one thing I think we can say with certainty for 2025. Volatility continues to be something that's on the rise with the market. And as we think about what the goal of these tariffs are, pay down debt and reduce taxes. We just mentioned that tariffs are a tax, so that outcome is somewhat questionable. The restoring fairness, again, depending on which side of the aisle that you're on or how you look at the world, some may argue quite a bit that yes, the U.S. could absolutely improve some of the trade deals it has in place with countries, but the U.S. is in this enviable position where we print money to buy goods that are manufactured overseas. So again, I think the market continues to reconcile with that. Bringing back manufacturing jobs to the U.S., this is something that's highly debated as well. As you think about the evolution of economies and you go from, let's say, an industrial economy to a service economy, reindustrialization, is that truly the future of the U.S.? And these are things that continue to get discussed and debated. And as the market continues to discuss and debate those things, again, these are sources of volatility. No one's going to argue about the curbing of fentanyl. We have, the curbing of illegal immigration. We have some refugees that came in from South Africa recently. So again, it's a very surreal time when you think about, policy and policy's impact on the markets. So as we think about, I'm going to jump ahead a little bit and just point to the outcome of the trade war, because we could really get in the weeds and spend the next hour talking about this. But fast forwarding to what it means that we've seen a huge spike in policy uncertainty. And as we've mentioned, the market doesn't like uncertainty. The market will rally when earnings just keep on hitting those numbers. The market will rally when people feel good. The market will rally when folks want to trade to the US or people want to vacation in the US. The market doesn't rally when there are question marks around all the things just mentioned. Additionally, when we think about consumer sentiment, that's souring. So we think about the consumption, the US being a consumption-driven economy, and the fact that consumption is essentially delicate at this point. That's also a concerning indicator to take a look at. The Atlanta Fed, you're looking at GDP forecasted at a lower rate. The estimated number came in at 30 basis points, negative 30 basis points last week for the first quarter. And again, the question now is not whether we are in a recession, but how deep the recession is. So that appears to be the sentiment across the board when we think about where the economy is. In addition to the Atlanta Fed, we can think about many other major banks also looking at the increased odds of a recession in the near term. And as we start looking at the market and various indicators, PCE, personal consumption expenditure, so inflation still is a little bit more stubborn than we'd like to see it. Job numbers continue to be, I'd say lukewarm in the sense of we're still seeing a relatively healthy job market. We're still seeing jobs get added. what's known as wage inflation still continues to exist. And this brings us to this strange place where the Fed is in a position where it probably will have to lower rates at some point, but it has to be mindful of this inflation. And then we pointed to the economy slowing down, and we've now, come across this term that's not spoken about too often, which is stagflation. What happens if we see rates cut, rate cuts are inflationary, and then we go through an economic slowdown, stagflation? What does that mean? So these are all scenarios that are very realistic on the table. The trade war truly is a direct consequence of this. And the market, as we'll see momentarily, has reacted in predictable fashions in certain asset classes and then unpredictable fashions in other asset classes, particularly on the non-US side. So when we look at the fixed income market, we see that the ag index was up 2.8% for the quarter. But then we'll also see for future periods, there's been more volatility on the fixed income side. Volatility on the treasury side of things, the treasury market, yields have spiked up, and there's been less demand for US treasuries. In this environment, we would expect US treasuries to continue to be a staple when you think about foreign investors and assets that people will run into. But going back to the trade war once again, part of the retaliation, one can argue, from some of the holders of our debt, China and Japan, would be to hold off buying treasuries during this environment. So not buying treasuries means that yields have gone up, because if yields, or I should say, if treasuries were purchased in greater numbers during this volatile period, you would see yields go down. That's the relationship between bonds and market panic and yields. But we've seen the opposite during certain periods where yields have spiked up and that demand for treasuries has not been there. So ultimately, fixed income continues to be a very good ballast, but we do see volatility in areas of the fixed income market where we would never expect to see that. We wouldn't expect to see treasuries trading with some type of risk priced in to the degree that we've seen recently. When we think about the yield curve, we see an inversion or re-inversion in the yield curve. So the lime green line points to where we were a year ago. The blue line points to where we are as of the end of March. So yields have come down, but that re-inversion has taken place. So that reinforces those concerns around an economic slowdown. When we think about a yield curve normalizing once again, yields will have to come down at the back end. Yields will have to come up at the front end. And as mentioned before, with those yields spiking up, that's usually an indication that risk appetites have gone up. There's more bearishness in the market. And then at the shorter end, that bearishness would potentially lead to rate cuts from the Fed. On the US equity front, we've definitely seen, again, more of a rotation into quality and value. So across the board, you see that large cap, mid cap, small cap, the value component has performed better than the growth component. As we think about the large cap side of things, your large cap stocks are going to be less sensitive to the projections around the economy. Your larger cap names, even though they're beholden to the global economy and the trade war, they're carrying less debt, they're less leveraged. So the fact that consumer sentiment has soured, the fact that there are concerns around trade and retaliation around trade, the irony here is we're impacting those small cap stocks that have more exposure to the domestic economy than those large cap stocks that have, again, those larger balance sheets and stronger cash flows. So that's the quick takeaway from the numbers on this page. As we think about the sectors that have done well in this environment and the ones that have sold off, we can basically flip what happened this time last year to your technology selling off, your communication services tangential with technology selling off. Your utilities have done well. Real estate also holding up pretty well. Consumer discretionary selling off, and then your consumer staples, the things that you have to have as opposed to the things that you'd like to have, rebounding. So your value-oriented sectors doing a lot better. And then in terms of the types of themes holding up well, defensive factors being the strongest contributors to growth. your value, your low volatility. These are the factors that have been very helpful in this environment in 2025. And then as we think about the tariffs, once again, this just gives us a very clear picture of just how quick, how steep, and how unexpected the movements in the markets have been over a very short period in time. The good news, I would say, as we think about us as long-term investors, while this is a period of pain, we've seen whether it's 2008, whether it was the sell-off in 2020, whether it was the taper tantrum, whether it was the sell-off at the end of 2018, typically the market will reprice and mean reversion works both ways. So as the market does go through its drawdowns, we typically do project stronger returns on a go-forward basis when you think about valuations, the attractiveness of pricing, and so on. I think this makes a compelling case for certain active managers to do very well in this type of environment as well. So again, as we kind of grapple with the tough news of today, we can think about long-term investing, think about our asset allocation, fixed income, the defensive tilts of the managers in the portfolio, and then ultimately, the conversation that Lee will bring forward. These are some of the examples of just being mindful and thoughtful about how we can capture some of the upside as the market does continue to rebound, but be mindful of the downside and areas where we should be getting protection as the market does sell off. So as we look at the non-US market, I'll hit upon this really quickly. And the really astonishing thing here is if we look at the local versus the core number, right? You look at the month-to-date number for the EFI local, and then you look at the EFI return. It's basically telling us that if you, or the quarter-to-date number, I should say, if you take 2.9% of a return in foreign currency terms, you get 6.9% of a result when you convert that to US dollars. So for your 2.9, that actually increases to 6.9. So that points to a depreciation of the dollar. What we're typically used to is the type of return further out to the right-hand side, where on the local side, you typically have a higher number. And then when you convert that to dollars, it becomes a lower number because we're used to the dollar being a stronger currency and getting less per unit when you convert a foreign currency to US dollars. But as a direct impact of the trade war, direct impact of lack of demand for US treasuries, this is one of the tailwinds that we've seen in the non-US market. So the non-US market has benefited tremendously from a depreciation of the dollar. The non-US market, once again, has also benefited tremendously from the anticipated isolation that the West may have from the US. The US will look to rely on itself more. I think the redrawing of the allies that we have also point to more transactional types of relationships as opposed to value-based relationships. So this is forcing countries such as Germany, France, typically countries that you wouldn't look at as military superpowers or guardians of the world order. These countries are now stepping up in terms of their militaristic spending. So this has also been a pretty significant tailwind when we think about some of the developed non-US markets. From a sector standpoint, we'll see the ACWI ex-US. There's going to be some similar themes here where the IT section has seen a sell-off, and then your quality sectors, your utilities, financials, and so on would have held up relatively well versus your IT. And then from a factor standpoint, we're also seeing value hold up pretty well, low vol hold up pretty well. Growth is still being rewarded to some degree as we think about the international markets, but definitely seeing more volatility on the growth side internationally as compared to domestic. And then from a country standpoint, we see again the US going through more challenges, Taiwan going through challenges, closely tied and linked into the affairs of China. So that's part of the reason there. But ultimately, we are seeing the impact of the trade war impact the US a little bit more from a sell-off standpoint. So with that, I'll pause and see if there are any comments, questions, In a moment, we'll talk about what this means for the portfolio. Once again, as we think about the overall market, and what I'll do here, actually, I'll point to some numbers that our team puts together every morning. I'll just point to how the market has moved through yesterday's close of business, just to give you a sense of, again, that volatility story that we just discussed. And as we think about the various asset classes, as we think about the diversification in the portfolio, the domestic market, we've seen such a huge rebound. We're up 6% as you think about the overall US market month to date. Now, we're only midpoint in the month, so a lot can happen. But already we've seen a pretty big resurgence in the non-US side of things. The fact that there's that 90-day, I don't know if détente is the right word, pause, cool, freeze on the tariff discussion with China, the markets also looked at that very favorably. So all of a sudden, you get a sense of how closely tied the US economy is to trade, given the fact that small caps are up now 7%, the US market is up now 6%. And that's really just off the back of that news of we're pausing this trade war. But with that being said, that year-to-date column, we're only slightly positive in many of the domestic indices, and we're very positive in the non-US side of things. On the non-US side, developed markets up close to 14%. The ACWI ex-US up 11.63%. And then as we think about the ACWI includes the US. The ACWI ex-US is without the US, and you just get a difference in performance of indices that's pretty material when you include the US or you subtract the US. So really, the story continues to be a very compelling one of volatility. It's too hard to say whether the non-US market will win at the end of this year, but they comfortably have gotten off to a very good head start. As mentioned earlier, fixed income continues to be an area that we have conviction in as you think about being a ballast in a portfolio. But fixed income is not without volatility. So you'll see month to date, fixed income has seen some cooling off. But year to date, fixed income continues to outperform most of the US equity indices. So again, it has been an effective diversifier across portfolios. And then as we think about other areas, for discussion, even though the asset allocation is set, we can think about REIT exposure. REITs do compose a component of the equity markets. REITs have held up relatively well versus other sectors. And then sectors or stocks that are tied to infrastructure have also held up relatively well in 2025. So as we think about active managers, quality managers, the sectors that they tilt to, we also get a sense that some of the sectors that they typically favor are the ones that would be rewarded in this volatile environment, which bodes pretty well for the managers in the portfolio as we think through their overall performance. So that wraps up the market environment. I'll pause. Happy to take any questions if there are any, and I'll turn it to Lee to go through manager performance.
Kwaku, just briefly, on page 28 of the executive summary was a list of asset areas that did well or not well during a period of time. And I noticed healthcare was one of the ones that did better, approximately 11%. Given the announcement or declaration or whatever you want to call it recently of the president concerning the pharmaceutical industry, which obviously is a subset of that healthcare, what are you anticipating going forward in that area?
Yeah,
because healthcare is traditionally one of the leans more defensive, right?
Yes. Yeah, that's an excellent question. I would say that some of the noise that we saw in the broader market, when you think about the tariffs, and there was really no plan or style around the tariffs, but we saw the market just react, and there were sell-offs and corrections and so on. I would anticipate a similar trend on the healthcare side for a couple of reasons. So on the healthcare side, one of the examples that was given was Zepbound Ozempic. In the UK, for example, it's £88 versus $1,300 for the same thing in the US. So that was a data point used by the White House to say that we're going to get it down to those price levels. The challenge is the system in the US isn't a socialized medical system, right? It's not the same as Canada, it's not the same as the UK. And therein lies one of the challenges there, where apples to apples, you can't just overnight change the prices that are paid. But with that being said, many administrations, Democrat, Republican, have focused on drug prices. I think that there will be some inroads. And if you think about RFK and some of the other individuals in charge of health within the country, I think legislatively there is going to be a lot more pressure on healthcare companies going forward. Now, with the healthcare industry, I will say this: it is like, other industries, whether it's the movie industry, car industry, where you have certain products that can claim a premium, and they're in trial, they're in development, and that premium is protected by the law. And then you have other drugs that are produced where insulin, for example, maybe the day has gone where it's $130 for a vial of insulin, and that does come down and become more affordable. So I think ultimately it's going to be a wash when you think about healthcare, because innovation still needs to take place, but there will be volatility based off the fact that there will be winners and losers in this. I think downstream, you're going to look at more M&A activity, more biotech firms, and more things being brought to market. But then on the flip side, I think the printing money from medicines that have been out for a long time, that day may be a little over for your Pfizers and Eli Lilly's and so on, which pushes some of the acquisitions and the buying of new medicines and new technology. So mixed story, given the fact that there's no plan as such on how the prices would get lowered, but the market will definitely have that reaction of essentially pricing things out. I haven't mentioned Medicaid or Medicare reforms to those either. There will be those direct costs there. And then if there is a repeal of the Affordable Care Act, does healthcare then become that much more expensive for the average American? So a lot of variables around healthcare, but still continue to view it as a great area to invest in. But your active managers will definitely be the ones, your private equity managers, in some instances, I think will be the ones that would capitalize upon this. And as usual, you're probably going to have the US consumer as a loser, as some do win on some prices.
I hadn't thought of the apples to apples comparison. That's an interesting point concerning socialized medicine. So maybe Trump has a metamorphosis and creates a universal healthcare plan. No, I'm kidding. But United Healthcare has been getting hit really hard, and I guess because of the Medicare proposal
Yes.
that's out
Yes.
there. That's interesting. All right, thanks, Kwaku.
Thanks, Brian.
Okay, would you like me to move forward with the performance review? Can everybody see? Can everybody see that? I've maximized the page there, so hopefully you can see those numbers. Well, thank you, Kwaku. That was a pretty comprehensive review there, the markets, and at this point, it probably foretells all the relative performance there, and you probably have a good idea how you did in Q1 and really how you're doing since the turn of the quarter. But let's just look back at Q1. You can see you did lag a little, about 50 basis points for the quarter. As you heard me say in the March meeting, that is predominantly attributable to being overweight equities at the beginning of the year. No surprise after that big run in equity prices in 24, you started the year a little overweight equity, and obviously US composite being overweight to the small caps relative to your broad market index was also a headwind there. And actually, if you look at the total fund allocations, even at the end of the quarter, you were still underweight fixed income somewhat. Where you are overweight is on the international side, as you heard Kwaku just mentioned there, with the Bit of stimulus enacted, particularly by Germany, on a defence spending package, and also the weakening dollar of about 4% there for the quarter. That was a bit of a shot in the arm for international stocks, and that's why you ended there a little over allocated end of the quarter. Good news is, as you look at the cash flow kind of chart at the bottom, you look at your ending market value and even your beginning market value. Since the turn of the quarter, you're now at 675 million. You can see that's quite a bit ahead of that beginning market value. So even with all this volatility and kind of downside pressure you've seen in the early part of this year, your fund is still positive for the year. So that's great to see. And then longer term, as you can see, great strong term long-term performance, a 10-year number of 7.5 above your assumed rate of return. Obviously, that's really helped funding for you in recent years. It's going to jump forward a couple of pages here, just from the cash flow point of view, just monitoring that. Yours seems to be a pretty standard, steady 1% a quarter of AUM that comes out, as you can see. 6.7 million there in Q1. It's not really growing too much, just slightly increases over time. No surprise, most funds here in PA at this point, as they're maturing, you do start to have more kind of retirees relative to new entrants and active employees in a pool. So as I say, nothing that you need to be concerned about. You have about 4%, as I say, going out for payables for payments annually. So let's look a little deeper down on the composites for you. If we jump to the fixed income, with spreads really narrow, very narrow relative to historic averages. There's not been a lot of opportunity for your fixed income managers to add much in the way of alpha this past quarter, and you can see pretty much right in line with bench there. Just starting from the top there is sort of your most defensive type fixed, and as you go down that page, there's a little more scope for the managers to add a little bit more return for you. So Barksdale, no surprise, really positioned somewhat close to the bench. So it's a bit of a no surprises approach for you, relatively low tracking error. And again, yet another quarter, within 10 basis points of the bench. MetLife was able to squeeze a little bit more return out for you. It would have a little bit more of an active play, a little bit more of a bet, so to speak, just been a little lower quality. Within investment grade still, but a little lower, down towards the triple Bs, and they were a little longer in duration at this point. So as rates came down in Q1, that gave you a little bit more opportunity to add return, which they did, as you see there. Similar story on the credit side. We spread it's pretty tight. Wasn't a huge bet put on here by MetLife, but again, similar that you see in their core product. They were a little lower in quality, little longer in duration there than the bench, and again, that's why added about 10 bips of outperformance. Where you did see some outperformance, at least relative to their their benchmark there in Q1, was Garcia Hamilton. As you can see, 3 relative to 2.4, which has been their bench historically. Really came down to that they have over 40% in mortgage-backed securities, which is not in that benchmark. And with rates coming down in Q1, with sort of stable MBS spreads, that was very much accretive relative to that intermediate gov cred. And actually, performance is more in line with the ag, which as of now, from April 1, Garcia Hamilton are now being benchmarked to the ag, because they're really running the management of this fund more in line with the aggregate bond anyway. So you should see a little bit tighter return to benchmark going forward there with that manager. And then finally at the bottom, we did see a lot of rate movement. There was a little rate spreads did widen a little bit in high yield, so you can see some did lag quite a bit relative to core bonds for the quarter for you. But as you saw on that last page, Kwaku provided, as it's become a bit more of a risk-on environment in the last few weeks, high yield is sort of led the way again as the spreads has kind of back down. Sky Harbor did lag a little bit. Again, a little shorter duration than the bench and a little lower in overall quality. Impacted that on the downside for Q1, and he's likely being a bit of a tailwind for them here in Q2. Just to let you guys know, on April 4th, that deal did close with Pew. So in future reports, you will see Pew Capital on as the manager, and obviously that'll give them a lot more resources to hopefully have some return above index going forward.
Lee,
Yes.
Lee and or Quaker or Chris, regarding Sky Harbor, we had a discussion, I don't know, a year ago or so about the benchmark for Sky Harbor with the previous consultant, and the question was whether or not that was the best benchmark for Sky Harbor. And I think there was some question about that, but that there was no real alternative to adequately measure Sky Harbor against. I wanted to get your opinion on that.
Yeah, Fran, and even though we weren't part of the conversation, I'm assuming it's because Sky Harbor is a little bit more conservative than the core index, right? That would be the discussion around them. So when the market's rallying and tearing, they'll lag, but over a cycle, the goal is for them to approximate the index with less overall risk. I'm guessing that would have been the basis of the conversation.
And the initial question was because we always see a difference between Sky Harbor and the index, a little bit more of a difference than the other fixed income products that are measured against their index. So because this is a public plan and because this is a public document, we understand there's an explanation, and Lee gave the explanation today on the difference, and you gave it. But again, I don't know if there's something like for Garcia, you have two different indexes down there, which Lee again explained why, because of the mortgage-backed securities. I understand that. I'm wondering if there's any possible addition or alternative on the Sky Harbor benchmark. And there may not be. I wanted you to think about that if you would.
Yeah, Fran, would it be okay for us to circle back with you all so we can take a look after this and then sync some notes up and then circle back if that sounds good?
That'd be great. Just work with Chris on that, because I think it's just something that, because this is published, it's a public meeting. I think it's important to either have a footnote or something in there so anyone reading this would understand that yes, it's trailing the benchmark, but here's why.
Yep.
Okay. Thank you.
Lee, you're on mute.
Sorry. Apologies there. I didn't know how that happened. I would say that there is a second, there is a benchmark, a shorter duration, like a BB, a little higher quality version that can be used. But when I look under the hood of that portfolio that ended that first quarter, it wasn't too far off what the broad high yield looked like. Was a little shorter, as I mentioned. But I think with this transition to Pew, maybe Quaker and I have a conversation with them, get some thoughts how they're going to manage this fund, and then we can come back to you with our ideas from a benchmarking point of view. Just pivoting to equities here. No big surprises other than to see your composite was behind. You can see down 5.4 relative to 4.7, purely because of the overweight, the small caps. You can see small cap was down 9.5 relative to 4.7 for the broad index. So no surprise from the performance point of view. All your indexing came in, exactly as expected. PineBridge did lag again a little. They do have really kind of left in place from last year some overweights to the small cap, to tech, particularly those AI related names, which sold off a fair amount in the early part of the quarter. So that was attributable to their underperformance. And then on the small cap side, although small caps were down, obviously this is the environment I discussed the last meeting, where you would expect a dividend growth type strategy to do better. And that's exactly what Copeland have done here. They were down only 7.3 relative to 9.5. So some pretty big outperformance on your small cap side of things. And then on international, as I said earlier, from an absolute point of view, you know, very good. And really the only lag we saw, and it really came in March with Acadian, again, with their overweight emerging markets, and emerging markets did lag the broad EFA for the quarter. So that was a lag. And also technology, again, on the back of Taiwan AI theme names, that really was a bit of a drag on their portfolio in March. But that was somewhat offset with Rumline and Ernest. So for the quarter, you can see pretty much again on benchmark, they have a strong 5% return for the quarter. So any questions on that past performance? If not, I can pivot to the discussion on Copeland. Okay. Hearing none, I'll just flip files here. Okay, great. And I'm just going to quickly take you through this. So this was something we discussed actually at the last meeting. You know, I noticed we do use Copeland in both the small cap and mid cap space for our clients. And you know, noting that you guys just have a 2-asset portfolio, stock and bond portfolio, if you'd like to sort of have a little bit more defensive posture in your portfolio for environments like we just saw in Q1, you know, one thing you could consider, which really is not a dramatic change, as I say, from having to do a search, etc., is just maybe have Copeland allow them to actually buy some of these dividend growth stocks in the mid-cap space as well, could potentially give you a little bit more downside protection for the fund. So I put this comparison together for you, and this is all as of the end of March. And the numbers you're going to see in here are for the composites, not specifically for your fund, because you obviously have flows over time in your pool. You're going to look a little different. But just something to note right off the bat here, you know, both these products have a good amount of assets in, you know, both over $1 billion. Small cap is more their flagship in the dividend growth. That's where they have most of their clients. So you can see 2.2 billion there. But I think the good news when you look at that is there's still a lot of capacity there. They're not coming against any ceiling there where they're worried about, you know, taking on more money investment. There's a lot of investment opportunity and space for them to grow both of these products. No surprise with the mid cap. Now you're allowing some mid caps to be bought as well. Obviously, it gives you a bigger opportunity set, a wider universe. So you can see, as of the end of March, there was 5 names, and you know, but at any point in time, you will notice there'll probably be more names in the mid cap because of that, just that wider universe they're able to select from. No surprise, because they're investing in these sort of larger dividend growers, tend to be a little more higher quality. No surprise to see that their market caps are quite a bit higher than the benchmarks. And that also leads somewhat, you know, because of, you know, these companies are paying dividends, they tend to be a higher quality type firms, and you look at these return on equity numbers considerably higher than the benchmark. And that often leads to better protection on the downside when you're seeing a risk-off environment. And that's exactly what you've seen in your portfolio this year for the small cap. From a sector point of view, again, it probably won't come as a surprise for you. Obviously, these strategies are going to be underweight the technology space. You know, they tend to reinvest all their profits rather than paying them out in dividends. So no surprise there that you're going to, you know, both of these strategies are going to look somewhat similar from a sector point of view, and they're going to be underweight, as I say, the technology, more the growth type areas of the market, and more overweight those bigger industrials that pay down the dividends, financial staples, that kind of thing. And that's exactly what you see here. If we look at equity style, currently on your small cap, obviously it's almost all small cap. You can see about 94% is in the small cap space. Once you go to the SMID, as I say, that you do bring some of that overweight, some of that allocation down in small cap and allocate it to the mid cap space, not the large cap. You know, there's just a little smidge there, but predominantly in that mid cap space. So again, that market cap can tend to give you a little bit more protection in risk off environments. And just something else to sort of note here, you will notice that these will sort of lean you more, particularly in the small cap space, because of the financials, etc., to the value side of things. So you can see growth compared to value is quite a bit underweight actually for both products on the small cap space. So let's look at some return characteristics. So I did this over 7 years. You're probably going to say, why do you pick 7 years, Lee? Well, when I turn over and you look at some of the trailing returns shortly, you'll notice that 7-year number is very close to your assumed rate of return. It's also a reasonable equity and fixed income cycle that is within that. So I think that's a good time frame to really compare these products at. And you can see returns have been pretty similar. And I think I've said this to you before, over a full cycle, don't expect to see much in the way of a difference in total return. What will change, though, is the path, how they got there over that period. And you can see their volatility is both of these dividend growth strategies, as you would imagine, would be less volatile than the broad markets because you're underweight those more aggressive growth areas of the market. And that's what you see here. And again, the mid cap is lower volatility than the small cap because of that extra market cap cushion that you get with the larger names. With that, though, in the SMID, you will give a little bit up on the upside. You know, when you come out of market sell-off, small caps tend to rip back a little quicker, as you saw with that last sheet that Kwaku shown, but would tend to protect a little bit more on the downsides. And again, that's historically what you've seen with both of these pools. Both of them actually only capturing about 82% of the market movements. And then just on performance here quickly, so really a good comparison looking at the 1 year and the quarter. You can see for the 1 year in a negative market, you might say, well, you know, why are these funds lagged the broad markets indices? Well, if you remember, it was purely because they're significantly underweight tech, and tech really ran for 3 of those 4 quarters. So that's why the lag's there. A more normal kind of downside quarter when it's more of a risk off type quarter, as you saw the last quarter, you can see here both these funds did protect. Actually, Copeland, that number -9.5, the composite was down 7.5. Sorry, that number I'll resubmit that to you with that correct number. I don't know what happened there. So, but the thing to note here is, you know, the SMID one, because of that extra market cap, was only down 4.8 over that period. And that's sort of what you would expect over time. You saw that over that 7 year. And you can see actually, if you go out to 7 years, you know, that's 7.3, 7.4, similar to your assumed rate of return, which is why we looked at that time period. If you go 10 years, exactly as I said, sorry, let me go back 1 page. Exactly the same returns, 8.2 for both the strategies, and quite handily outperforming over a long term because of that compounding effect of protecting more on the downside, not digging as big a hole. So when the market recovers, you recover quicker. So just to wrap up for you, just you know, a couple of considerations here for you. You know, you got the potential to, as I said, to reduce a bit of that market cap underweight you have to mid cap right now relative to your bench. benchmark the Russell 3000 for the domestic equity. You have large caps, you have small caps, you have a little bit of a hole in the middle. So allowing Copeland to maybe move up and pick some names there will lower that tracking error of the US composite relative to the Russell 3000. Obviously, as I said, as you're adding a greater opportunity set because you're allowing some mid caps to be bought. You know, inevitably that allows the manager to add a bit more diversification in your pool. As you've seen, market cap, you know, the larger the market cap often adds protection in risk-off environments, as we've seen this year. And, you know, if you did want to move forward, I know their standard fees, and I've seen with our other SMID clients that their fee tends to be a little bit lower than the small cap. And if you did want to move forward, obviously we could have that discussion with Copeland for what potentially that fee could be for you for the SMID product. So I'm going to quickly thrown all that at you. Any thoughts or questions for Quaker or I?
So the returns, I appreciate the comparison. It's an interesting comparison. You indicate that there's a void in the middle in the market cap, mid cap area. Aside from the active managers, then why would we not just invest everything in the total stock market index? Then we have a void nowhere, right?
Sure. I mean, long term, I think it's shown that overweight in that small cap has been accretive for you over that 10-year type period, over a long-term period. And obviously, we're talking about a long duration pension fund here. By investing in the market, you just take away that variability more on the short term.
Well, but I mean, as far as having a void in any particular
Sure.
area, that would disappear, right?
Correct. Mm-hmm.
Yeah. So,
but you would capture all the downside and all the upside.
I understand.
Yeah.
I think the reason for Copeland initially and the returns between the SMID and the small cap over a 10-year period are non-existent, right? They're 8.2 over the 10-year period, a little different in shorter duration periods of time. And I think the small cap is more of a true value protecting on the downside, at least as far as the returns seem to indicate. Is that right?
Yeah.
Okay.
Yeah, you lean a bit. It'll have a bit more value to it. Correct.
So the reason I asked those questions is, if I remember correctly, when in reviewing Copeland previously, part of the reasoning for investing in Copeland was that it acted differently than a lot of the other funds in that it was more defensive and protected on the downside. It appears that the SMID does that, but not to the same extent. So what I would ask Chris is, how does that affect the original thesis for investing in the Copeland fund? And is it still consistent with kind of what the original thesis was? Because I think that investment predated me. I've heard discussions about it, obviously, over the last couple of years, but I think the reasoning for the investment predated me. We can't hear you, Chris. Still, no.
Still can't hear you. Can't hear Chris.
No, we can. I think he's trying to log back in, Don. He disappeared. He's going to try to log back in.
Did that work?
Yes, sir.
Yes.
There you go.
Sorry. I think it's still largely consistent with the original thesis. I think all we'd be doing here, for the most part, is giving the manager a little bit more flexibility. I also think, given the strong likelihood of lowering fees, that we would have an opportunity to pick up perhaps a bit more incremental return. If the fee goes down 5 or 10 basis points, and I don't have it right in front, what the final number would be, then maybe the 10-year number Lee provided, goes up by half a basis point or 10 basis points. So I think it's still largely consistent. I think we're giving the manager slightly more flexibility, and it would only require a pretty minor, in my view, pretty minor change to the existing investment guidelines in order to accomplish this.
Chris, from a procedural standpoint, would we have to agree to adopt the change in the guidelines first before making this decision? Or could we do both simultaneously?
I think you could do both simultaneously. I'm certainly happy to come back either at a meeting or offline and share what the difference in the guidelines would look like. I think it would largely reflect what Lee walked through, which is to allow a little bit more movement up the market cap. But I don't think it would be a major change to what exists with them now.
Are there any, I guess these are mutual funds, I assume, these are, or would there be any transaction costs in moving from one to the other?
Only, go ahead, Lee.
No, I'm going to say, no, you could keep it in the same,
Got it.
SMA vehicle that you have. And then they would just add some mid cap names, over time as they feel that opportunity presents itself. As you saw, there was only really a 5-name difference between the two at the end of the month.
No, I think in theory, it sounds like a great idea. And Chris, I appreciate your opinion on that. So I will, I think it's a good idea. And I think the more flexibility the manager has, the better, especially if there is a void in the mid cap area. So yeah, I think that's.
Is there action that we need to take?
Chris.
If there's, I don't know if the bill or the controller's office, but I think if, Don, you're comfortable with it, Fran, Bill, and you state so on the record, then I think that's sufficient.
We're comfortable with it, and if you need, we can make a motion to make that move.
Okay.
I'll second the motion.
So do we have a formal motion there?
Yes.
And the motion has been seconded. All those in favor say aye.
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 Aye. Motion passed.
Thank you.
Thank you.
I think the last agenda item, Don, unless anyone else had new business, was just to confirm that folks were comfortable with me putting a special meeting in June on the calendar. And that would be just to review 2 or 3 auditor candidates. We've required to do that pursuant to ordinance, city charter, etc. So I don't as long as folks are comfortable, then I'll schedule that. I'll send out a couple of dates mid-June, and that would probably be the only agenda item absent something extraordinary in the markets that we needed to review. So if folks are comfortable with that, I'll send out dates.
That works for me.
Fran, Bill?
Yeah, that's good. Chris, there's possible I may have an issue with the July 16th meeting, but I'll let you know.
Okay. And if we have to I was just going to mention that was the next regularly scheduled meeting. Hasn't been advertised as it will be, pursuant to legal requirements. But if we need to change that, we certainly can.
And Chris,
That was
you're
all.
aware of an issue at PGW with one of the higher ups in that area. Is that anything that affects any of the things that we're doing or payments or anything from PGW, or is Dan able to move forward and take care of whatever's there?
As far as I know, assuming you and I are talking about the same thing, and I'm happy to talk to you about it offline. I'm not aware of any issues, and I believe that individual should be back with the organization in very short order.
Okay, great.
Okay. That was all I had, Don.
All right. Thank you, Chris. Thank you all. Is there a motion to adjourn?
So moved.
So done.
Second.
So done. Thank you.
All
Thanks,
right,
everybody.
thanks, guys.
Take care.
Thanks, everybody.